so, helped in part by hotter inflation data. Treasury yields had moved up until a week or so ago. And from the low point earlier this year, the 10-year Treasury yield was up by 73 basis points at its peak at about 4.67%. But you can see where that increase stands relative to the long-term history. Here we're looking at the largest increases within each year, the largest increases in the 10-year Treasury yield within each year, going back to the year 2000. And you can see that we often have had sizable increases within calendar years in long-term Treasury yields. And often in these cases, Treasury yields have eventually moved back to the downside. 2008, for example, at one point in 2008, we had an increase of nearly 1 full percentage point, nearly 100 basis points from the bottom to the peak. But then, of course, Treasury yields rolled over, and by the end of the year, we had much lower long-term Treasury yields. Some of these increases have stuck. Obviously, 2022 is a prime example where yields moved up aggressively and stayed up. We still saw a relatively large increase for the year as the Fed began an aggressive rate hike cycle. But just to put that in the broader Treasury market into context here, throughout this entire period, we've heard many calls for the end of the long bull market in U.S. Treasuries, the bull market that began in the early 1980s. Every time, or virtually every time, we've seen a spike in long-term yields. There have been some analysts, some very prominent analysts, who have called the end of the bond bull market and have called for a new bear market to take hold in Treasuries. And so many of those forecasts, of course, have proven to be premature. We had, of course, in the early 2000s, Bill Gross famously saying the bond bear market has come to an end. And when it didn't, well, about 10 years later, he said it again in the early 2010s that the bond bull market has come to an end. Of course, it didn't come to an end at that point. Perhaps it ended in 2020 after COVID, and we had ultra low long-term yields. That book has yet to be fully written. But throughout this period, we've seen a lot of calls for a structural change in the Treasury market, and a lot of those forecasts have been predicated on a structural change in the inflation rate. And again, you see the big move up in Treasury yields in 2022 and again in 2023. As inflation did spike, we had 6.6% core inflation. We had an overall inflation rate above 9%. But think about what produced that inflation rate relative to the experience of today. We had a pandemic, hopefully a once in many lifetimes pandemic. We had ultra aggressive monetary policy with the Fed pushing short-term interest rates back to zero, pursuing aggressive quantitative easing once again. And we had unprecedented fiscal policy. Fiscal stimulus was off the charts in the early 2020s relative to any experience in U.S. history. Based on the fiscal stimulus bills of the early 2020s, we had fiscal accommodation along the lines of 25, 26, 27% of GDP. Compare that to the post-global financial crisis era when fiscal stimulus was roughly 5 to 6% of GDP. And meted out over a much longer time frame than it was in the early 2020s. That was the backdrop that gave us 9% plus headline CPI, 6% plus core CPI, and a spike in long-term Treasury yields, obviously, as a function of an aggressive Fed tightening cycle. Now we have sharply higher oil prices. We have, at least temporarily, an increase in the CPI. We have a Fed that's wavering at this point, but is also in a transition period to a presumably more dovish regime. So we are nowhere near to the environment that we were in the early 2020s. So the very bearish calls for the Treasury market highly unlikely to come to fruition, just as so many of the bearish calls over this period and the period before this chart, the 1990s and the later 1980s, before those, when those bearish calls were made. Obviously, those did not come to fruition.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.